I mean, yeah, there's a much higher probability that you have something like that happen than the market trade on a presidential cycle or seasonality. By the way, on the presidential cycles that you cite, did it include like a shit show like we have with even the Irish guys, McCarthy and McHenry, and like
Here's the
I mean, it's like the conditional factoring. These people don't. Oh, look at that. Go back. Go back. There was a nice picture of a Godot version. Hey, no, go now. Scroll down to the AI. AI. No. The AI. You just had it. The 1987. Go up. There.
AI.
You just had it. There it is. AI. October 1987. Type seasonality.
I was going to say, like, this presidential cycle stuff, obviously follow politics closely, but if you're being quantitative or analytical, it's not enough data points. It's like, so you have however many presidents or modern markets.
Yeah.
Okay, so maybe it's performing better, I don't know, but like, that's not enough data points to conclude anything.
Well, let's just say that
Like,
you're
no, like, not even the COVID drug tests would have that few statistics.
right. I mean, so if you're this kind of a person, this is not an investor. This is the type of baby boomer and Gen X person. Not as many millennials because they weren't there for the first two recessions. Certainly not making market calls or assumptions. Let's really think about it. Why am I so critical of the old wall and these chartists and whatnot? They don't have any other vision because they don't have any other option. They have and many of you had this. Until you had Hedgeye, you didn't have our research team, our models, or any of my signals. I get it. If you don't have any, like watch me go fishing with Luch, my best buddy in Thunder Bay. I'm as clueless as a chart monkey. Now look at his tackle box and all of his weaponry. Like, that guy can fish and hunt,
And build.
and build. Like,
And arm wrestle.
now, if you don't have any other choice, you're just mucker with a rod saying, Luch, what should I put on the rod here? Or, by the way, when that bear came over on the right up on the shoal there, Luch takes out his fucking shotgun and fires one to scare the hell out. And I didn't even see or hear the bear coming. Right? You gotta have people with competence. The reason why these chart monkeys exist is because A, there's a chart that gives an illusion of safety or visibility. They have a fishing rod. They have a chart, and B, to Jonesy's point, they have one or two talking points. Okay? They just talk. That's called being frequentist theory. Well, this happened this percentage of the time, therefore. Again, just like the rattling off like Stephanie Link Geraldsley does, a multiple on something that she doesn't have a model on, anybody can do these two things. Provided that they can read, I would say that my kids could achieve the level of analysis, that level of analysis, by the age of 8. Okay? So, yeah, it's a joke. Yes, we're going to be critical of it. And B, we're going to show you a better way. Okay? Next question.
Okay, you've hit on some of this, and an interesting one that was oil today, but I'm going to ask the question. What's a large asset allocation shift you're potentially considering at the moment, aka signal strength breaking down in a bullish trend, or conversely, signal strength picking up in a bearish trend? You mentioned a bunch of ETFs that you've added that are doing that. Thanks. So large asset allocation shift that you're looking at, or is maybe more in the yellow area?
Well, I mean, the best way to, and this is a Macro Pro subscriber, so the best way to get that answer daily is to watch the positions go up and the positions go down, right? If they're going down, that means that they're losing signal, either losing signal strength or signaling immediate term trade over bot where I'm booking some gains. So if I do that, the second one, that means they come down from the top of the list a little bit and stay in the middle of the list. When you have 25, 30 asset allocations, that's the way it goes. If it stays in that top third of the list, then it's a bullish trend. If it's moving down into the middle to the bottom part of the list, like JPXN, which is right at the bottom, that means that it's lost signal strength. Small cap Japan had been losing signal strength. It was in the bottom part of the list, and yesterday I took it up. So that's the functional answer for you, all you Macro Pro subscribers, because you get to see that every day, right? That's like watching Luch. Like, I watch him. When he starts paying attention to his rod and his hand starts moving, I'm like, there's definitely a fish around here. Get my line in the water, right? So we need you to be good observers of the answer, as opposed to the old wall way, which is, Keith, can you give me a couple ideas? a couple picks. What are you going to buy? No. What are you buying is a better answer. What is he doing? That's the answer, actually. Okay? So something like turkey's not on our sheet today, but it could go back in there, but may not. So the things that have come in most recently, I already highlighted them today in the top 3 things. There's a lot of stuff in there that I've added recently because they've developed signal strength, or they wouldn't be new positions. So pay attention to them.
Okay.
CYA is probably the most obvious. I mean, that's the one where that's a direct function of my view that the regime shift has happened in equity vol, or the VIX in particular.
Okay, are we entering a time when a rate steepener like IVOL makes sense?
Yeah, I've been saying that, but I didn't buy that. Because it's not steepening for the reasons that I would buy it, nor is the signal confirming anything other than it's medium-term trade breakout for sure. So when you look at, if I look at, let's take this, cancel all of your use of that stuff, and let's start with a better way. So I look at the risk range of YC2C, for example, in my calc, which is the yield curve 10s minus 2s. The risk range on that, I think right now is minus 70 to minus 20 or something like that. The medium-term trade breakout line is somewhere in the middle of that. So when it went from minus 70 to minus 55, the yield curve itself went bullish trade, but it's still bearish trend, okay? So that's not going to be a major asset allocation and you can look at every single time the yield curve on those metrics has busted a move to medium-term trade breakout on my own math. It's been a head fake from a trending perspective. So that's why I'm watching. I literally talk about things that I'm looking at. It's number 5 on I haven't bought it yet, right? But it's there. We're paying attention, always.
All right. This is an oil question. This is a longer-term oil question. Keith, in 2008, XLE was trading at 88, similar to today. It was then cut in half as a recession and bear market hit. Are you concerned that we may be seeing something similar later this year as the recession hits hard? Also, as of today, OBX hit 33.25 above the 33 threshold we mentioned. I remember 2008 vividly, and my only real mistake was to hold on energy too long. Wouldn't want to repeat that mistake. I guess, I was thinking about energy too, because that's some energy positions. What really helps all of us is the risk ranges and levels and price picking up.
Yep.
Regime change. But in a recession, yeah.
One, I don't start with the way the question started. I remember, therefore, who cares what you remember? Just, if you have a chart, you can be 7 years old and remember everything everyone should remember, right? It's the whole time series of the day. So I obviously know what happened in 2008. The second part of the question is the answer, right? Which is, what is the signal? That's it. We have a stop loss for that. So, in as much as I'd sell Japan if it breaks trend, I'll sell XLE like my mom if it breaks trend. I won't wear that the whole way down, and I didn't in 08. Okay? So, and my signal's far better today than what it was in 08. But the signal is always the answer to the question. Okay? So when we think about that, keep thinking. I mean, it picks up, there's a lot of reasons why energy stocks break down in a raging bear market, because people, again, there's exit liquidity, you can't own anything, the rate of change of oil peaks and starts to roll over, then breaks down. I mean, that all happened in 08. It could happen now. I don't wake up thinking about that like as a primary thing. I just wake up looking at my signal. Now, what did I do in XLE, XOP, PSC, EI, you and me? Did those positions, that's a Macro Pro subscriber, what have I been doing in most recent days and weeks? Have I been taking them up to the top of my list? Or yesterday, what did I do? I sold some of XLE, even though it wasn't up. Okay? So the position is down pretty close to my minimum. I have that position actually, right at 2%. XLE the day before was 2.5%. I sold 50 basis points. So the signal is already getting me better position for your primary concern without me having to worry about your primary concern, which is 2008. You see the difference? It took me a long time, really, to stop with the narratives, right? I mean, my own narratives. Hey, Marcus, remember back in 1998 when you had a breakaway against Ohio State and we had to win that game to move on in the tournament? You hit the fucking post. You remember that? Yeah, I remember that. Well, do I start what I'm going to do like as soon as we're done talking about that? No. No. Play the next play. Play the next signal. Play the next game. And that's really important, and again, it's being constructively critical about the question, because the question should start with the signal, not with a, oh, this could really scare me type thing, because I remember that, right? I remember that game. Yeah. Jeff Hamilton was hurt. It would have been better if he had that breakaway, because it probably would have been in the back of the net.
All right, we're going to wrap it up there. Thanks everybody for tuning in. Back at it tomorrow at 9 a.m. Have a great day out there.
They're also get into it this morning, it will be a busy one from a data perspective. Number one, 10-year yield. Number two, Japan. And then number three, hit on the equity market volatility signal, of course, which is how we think about everything and always have. First on the 10-year yield, when I got up this morning, it was at 482. The risk range has gone to 485 on the 10-year on the top end. This started slowly and then all at once. So the first arrow there, Jonesy, is the green one where inflation started to break out to the upside, oil in particular, and then it broke out all at once. So again, we haven't been bullish on bond yields for like a day or 5 days, or now that probably the worst thing you can do in your life is watch CNBC, uniquely American FOMO stock market people talk about the bond market now. So again, they'll fuck it up and it'll be what it's going to be. But we didn't. This is one of the better calls we've made in a long time. Again, just being, or having the humility rather, to just listen to the signal itself. So now, of course, I take my red eye off because bond yields come down, and that'll be the whole narrative. Bond yields are done going up. They're not done going up, okay, until the signal says that they're done going up. And by the way, it's much more about the level that they maintain. So I pay a lot of attention now to that big higher low on the 10-year yield of 442. I'm old enough to remember when the top end of the range was nowhere near 442. Now, so if you correct the 442 on the 10-year yield, of course, gold will stop going down, and a lot of these rate-sensitive moves will stop for a short period of time. But the trend, which is the full investing cycle point on quad 3 stagflation, will remain your friend. And again, we're long of inflation and we're short rate sensitivity. You can see those in the top three things. I put a whole bunch of tickers on the board. And again, talk about Macro Pro subscribers, Jonesy. There's a lot of things in there that if you're paying $30 a month, you didn't get, right? Like ETF Pro didn't have, I don't think, CYA, for example, or the addition of CTA, again, and VTEL. These are positions PFIX that we've had for a while. But again, there are a lot of reasons why I won't put it in ETF Pro, but again, they're sitting right there. So those are all the positions that I currently have, and I'll be adding to on both the short side and the long side when the positions go the other way. Again, I don't chase. Again, I press shorts when they're green, and I buy longs when they're red. Point number two this morning, Japan. Okay, so now this might reverse. We're going to have to see. But 0.8% on the Japanese 10-year government bond yield, or the JGB 10-year yield, that definitely had an impact. Okay, so the move, for that matter, from 70 basis points, 0.7% to 0.8% on the JGB 10-year yield, it looks directly opposite of what just happened to the Nikkei. So there is rate sensitivity there. Now we know that, and the risk range just blew out on JGB yields. Now, can they get it above 1%? That's where 10-year swaps are trading, and that's pretty much the cap that the Japanese want to keep on top of their experiment here, which isn't an experiment, it's just a practical matter of yield curve control. We'll have to see. But again, I want to be as crystal clear as I can on a couple points. One, we sold all of the small cap exposure, so SCJ is no longer in the asset allocation model. If you get that daily, you would have known that. I also did that actually in ETF Pro. I took it off just to make the point. Two, we'd already been taking down our Japanese equity exposure because three, Japanese equities had broken medium-term trade support. They're still bullish trend. They don't look like India, which is bullish trade, bullish trend. And that's what I've been doing. So again, that's why they're near the bottom of the list as opposed to the top in the asset allocation model. And whether or not you saw that doesn't really matter, right? What matters is what I did. So again, we're going with signal strength. I've explained it many, many times. If 30,289 breaks on the Nikkei, the probability continues to rise that I not only take the positions down, but get rid of more of them. Okay, so again, it's just called a stop loss. I stopped myself out of China on the long side this year, out of South Korea. Why wouldn't I do it in Japan? It has nothing to do with the fundamentals, okay? We can go through the Japanese data. It continues to accelerate. And maybe if it holds, and it should hold, if bond yields come in a little bit here, then it holds. But get yourself in a position to, I don't know, I don't care, I execute on the process. Try it. It's going to take you some time, some of you, and I know it is. But the more you can get closer to me on that front in terms of being really, it's a dispassionate decision. It's a data-driven decision indeed. Point number three is the VIX. Now, this is just straight up, bad. Okay, so we've had a 14% drawdown in the Russell 2000. The drawdown in the S&P 500. It's not a correction. It's a drawdown of 8%. Again, a correction is down 2, 3, 4, 5%. So again, a drawdown. The Nikkei is having a drawdown. It's down 7%. So again, it's not as bad as some of our shorts. I mean, the Hang Seng on its own is down 10% in the last month, for example, and continues to crash. So have your longs, have your shorts, so that you don't have an aneurysm being long Japan when it corrects. or enters a drawdown, which it's currently in. And then you got the VIX, that big high or low number, the most important number arguably on the page today in terms of all the data that I've written down, is 1612, 16.12. That's not only a big high or low, but it's well above where it's been, and you can see on the Tier 1 Alpha data, Gendron, the term structure, if you look at very short dated vol against the calendar, which is one of the most important slides that they provide in their daily stat pack. Craig and the guys put that up there on the board. You've seen a complete change in terms of the structure, the term structure of volatility in both short term, but not so much on the intermediate term, where you can easily see the VIX get, I'm old enough to remember this year in March and April when we were proactively prepared for that banking crisis being the credit event that's still ongoing, where the VIX went to 27, 28. So that's where I'm at on that. Prepare for that. It's going to go all non-linear on your ass if you're a permaball, and I like it. Those are your top 3 things. Right. It's kind of like a one-liner from Talladega Nights. Remember when the kid says to the old wall guy, the grandpa, like a spider monkey. By the way, update from, remember this? I think we got to do that, right? Gendron, can you show a couple charts? Let's show the Russell 2000 one more time. Worse than that would have been being long real estate. So let's go from that to the XLRE. That's down 33%. Russell's down 30. Now, I can't for the life of me understand, Jonesy, how that's a bull market. Like, that look like a bull market to you?
No, not really.
But the bull market is back. All right? If you think that I am going to let these idiots that were chirping me for the entire month of July off the hook, you're out of your mind. Mucker has a very long-term memory when it comes to people to chirp. Ask Jonesy Butts or the Princeton hockey team, okay? So you want to chirp, get ready. I'm here, I'm not going away. And unlike them, who are very quiet when they're wrong, and you notice that, like even on their process, like these chirp monkeys like Ryan Detrick, just to name one monkey, I mean, they don't actually go both ways on the process. Like throughout July, they'll be like this many stocks above the 50-day, the 10-day, the 200. When they're below them, there's no bearish call, right? There's just crickets. So it should get me agitated. It should get me excited because that's the competition, and I'm going to beat their spider monkey ass. That's what's going to happen, right? So again, like for example today, and my whole trade trend tail model is built on front-running 1-month price momentum. 6% of stocks in the S&P 500 have positive 1-month price momentum. 6. Does that sound low? Oh yeah. It's in the second percentile on a 10-year look back. This market, technically, to a technician, should be the most bearish market they've seen, or at least one of them, in 10 years. But they're not bearish. Like, they're clowns. Like what they're doing right now, like the Fundstrat guy, I mean, it's like a clown trick, right? So I'm going to stay on them. Yeah, I'm going to stay on them. I don't care about being classy. I'm not classy. I'm Mucker, right? S&P 500. Let's go. All right, S&P 500 risk rate. I'll be classy, like with my wife and daughters. Ryan Detrick. I mean, come on. 4210. And I can't wait to start an asset management business and series of products to compete with the firm that he works at. That's going to be fun. 4210. Those guys are just asset gatherers. 4359. You don't want to be an asset gatherer. You want to be an alpha generator. 4359 is a big lower high. Now, we've had big lower highs, but I haven't said big lower high. I've had big lower highs, Jonesy Butts, but this is a big lower high, okay? This is inside of the flip line in terms of dealer gamma. So you can see that flip line today, according to Tier 1 Alpha, is 44.04. So that's inside of 44.04. Look at that. So the best you can do, if you were to see a 3.1% rally in the S&P 500 from here, it could happen. It happens in bear markets all the time. You're still in a negative gamma position from a dealer perspective. Every index point in the S&P 500, not percentage point, is $1.7 billion required in hedging by the dealers. Okay, we're in territory that we've never seen before. Okay. Now, in the 2 percentile of historical readings on 1-month price momentum, I'll call that pretty close to never. So when you really think about what's going on, it's not about, it's such a low bar, right? Like competing with Telecom Tom Lee and the frickin' bear markets, he's never called one ever. That's not our competition. Our competition, to be very clear, is right in between these two suckers, right between our ears. Our competition is ourselves in this part of the game, because we're the only firm that has any historical track record of risk managing it accurately. So again, we have a lot of things that are going on out there. Please stay with the process, don't panic. If something breaks trend, get rid of it, or at least reduce it as it starts to lose signal strength. And if it builds signal strength, build those positions. Ride your winners, get rid of your losers in both your portfolio and your life. Now, what else we got going on for you? I just hit an all-time high 2 days ago. We're still getting T-Flow, T-Bill, FDRXX, these payouts. We're seeing a correction in energy stocks. By the way, I did sell oil when it was green yesterday. You saw that, right? Well, you didn't want to pay for that? Did you want to ask about that? Well, that's the point, right? Okay, now we get to buy some oil back because it's down 2%. Just FYI. Let's just finish up on the taking the laps around the pool here on the factors and the sectors. Sectors yesterday, volume was actually not enough. I still think people haven't had enough exit liquidity. Don't forget the day before when we had 78% of stocks down and the average decline was 1.7%, but you had what everybody really owns and they just want their bubble back was up. And then yesterday it was all down again. Just a bloody disaster for big stuff like the XLY, which includes obviously Amazon's beatdown. Amazon took a peek at the trend and failed like a boss. We got Apple, Microsoft, these stocks just look terrible. The average decline yesterday, by the way, with 80% stocks down was still 1.8%. So it's just a terrible thing. That's why my trolls are very much like crickets this morning. What else we got going on? Move index at 141. Whoop! Whoop! That'll wake you up in the morning, huh? And you know what? Let's say the jobs report's dovish. They weren't able to. They couldn't spin that JOLTS one as dovish. But let's say that let's try to play it out. How do we get the 10-year yield lower? They need it. They want it. They have to have it. Let's just paint the jobs report on Friday as dovish. That could happen or not. I have no idea what that jobs report's going to be. But what we do know is that at some point in the next 6 months, you're going to start seeing some bombs in the labor market. And bond yields could easily go down as inflation continues to go up. So that's called quad 3 stagflation, and the bond market's figured this out. How about the broad bond market? Now, I've taken a lot of shit this year, but this is probably the easiest bear market I've ever called since 2008. Right? That's high yield. Okay? HYG, right on the screws when somebody was asking about it. It was a top 3 question in the queue. Why isn't high yield working anymore? And I'm like, are you out of your mind? It's been working great. So now you can see why I'll get a little agitated about dumb questions. So again, I don't want dumb questions. I don't want a dumb team. I always say it. I say it to 8-year-olds. I say we're going to be the smartest team and the hardest working team, right? In terms of not intellect, in terms of how we think and play the game. I don't want you to be dumb. Okay? I don't want you to wake up in the morning with anxiety or panic attacks, asking stupid questions. We want to have a team that's proactively prepared, is asking insightful questions on actionable items. Okay? That's the positive message we want to have. If you want more positivity, read the Bible. I love the Bible. Right? Please don't cancel if you're not. Just take a look at it. But look at that chart. It's one of the best shorts ever. In a day, high yield spreads are up almost 20 basis points wider. That's a lot. And as I said yesterday, risk happens slowly in the labor market, then all at once. If that's their catalyst, people losing their jobs, they're going to lose their year-to-date return. Okay? So anyway we go here, currently we're in a pretty good spot in terms of what the consensus thinks they want, but what they get when you get a deterioration in high yield spreads, if 400 over goes to 500 and then 600 over, is it just doesn't stop. Okay? That's why the red eye keeps going on and off, because I've traded bear markets successfully before. If it agitates you because you're just an agitated person, get over it. You've never risk managed a bear market accurately before. You shouldn't be used to this. You should be agitated maybe. But maybe you could just take a step back and say, maybe the guy knows something here. Maybe he knows what he's doing. And maybe I don't. Right? Or maybe I do. Yeah. Got a lot of thank yous on that too for a lot of people that do. And thank you for that. I appreciate it. What else we got going on for you this morning? Got Asia already hit on Japan. India is fine. There's no trade or trend breakdown. Yes, there's a lower high in the risk range. There's not one equity market in the world, including Pakistan, that is not signaling a lower high at the top end of the range. Whether it be a bullish market, which is United Arab Emirates, India, and barely Japan. There are only 3, or I'd be long the other ones. Turkey actually is the 4th. Bullish from a trend perspective. Think about that. There aren't many. Right? It's not like UAE found Kuwait for Any of the other Middle Eastern equity markets bullish trend? Those aren't. KWT? Nope. Qatar? Nope. Qatar? Nope. Qatar and Qatar, same thing. What else we got going on here? I didn't know that before. So many things that I don't know. But if you talk to somebody from Qatar, they'll say they're from Qatar. Yep. You ask somebody if they're from Toronto? No. Toronto. Okay. What else we got going on here? The knowledge, right? The knowledge you'll get on the macro show. Did I say Hong Kong's down 10% in a month? I did. Whereas India's only down 0.5%. Our shorts in Europe, I covered some yesterday in both EWD, which is Sweden, and Austria, EWO. You got those signals and real-time alerts alongside the oil signal. Oil now 87.13. Now, to be clear, we've been bullish on oil since it was in the 70s. Okay? So it's like gold. Got long was in the 1700s. So again, I don't need to apologize for corrections. I need to help you risk manage them. So what I said yesterday, given that people need exit liquidity, they sell what's up because that's what they do, because they need liquidity. You know, oil's one of those things. It's the best thing you could have been long in macro for 3 months. So it's correcting now. It's also giving me my first set of lower highs, barely. Okay? So that's less bullish. You don't have to boil the ocean over it. Jonesy doesn't have to give me an inventory update on it. No, it's just what it is. You go from every single day a big higher low and a higher high in the risk range of WTI to today it's 87.13 to 93.29. By literally or mathematically by 0.3, again 3 basis, it was 93.32 the top end of the range on WTI. But it is what it is. You get what you get. You don't get upset. If oil has big higher lows and higher highs every day like it did, it could move to the top 5 position in my asset allocation model, and it did. Now it's not. Nope. Nope, nope. And if you don't understand why, I have to be firm, okay? We're going to be firm with the process this time. We're not going to put up with dum-dum. We're going to get you smarter about the process, right? I said this, I started in July. I said this is phase 2 of hedge eye risk management because not enough people that are paying for it understand the process like I do. So it's my goal to coach it, but I have to coach it firmly. I don't walk into a dressing room, or Jonesy for that matter, at the brick tournament and say, okay guys, can we all talk about feeling good? No. Let's get intensity. Let's get to where we've been so that we can beat the shit out of that team because they're not ready like we are. Okay? Let's go. What else we got going on for you this morning? 18.14. Low end of the range on gold is below trend. What do we do with that? What if it breaks trend? I'll sell it. I'll sell Japan. Yeah. They're the same trade. Okay? It's bond yields. Okay? So it is what it is, and we're going to stay with the process on both of those things. Both of those things. Dr. Cosby, Dr. Cosper, Dr. Copper. Smoking a cigar last night. Dr. Cosby and Dr. Copper is a similar set in practice, according to me, in my model, and it is both bearish from a global macro risk perspective. Good. If I talk slower, then the phone, the cigar problem, all my problems don't come out like that. A little slower, a little bit more measured. I don't think you want that. You do. 442 on the 10-year yield to 485. I've already talked about that, wrote about that in the top 3 things. You got that note? How about that markup in Luna Coin? You see the month-end markup in Luna Coin? Like, there is outright manipulation, cheating. There's so many things that happened during the mother of all bubbles, which included, of course, crypto at those November 2021 highs, which we help you risk manage. But there's still a lot of manipulation. There are a lot of people that cheat. This is something I wanted to say. And how about Bitcoin? Day 2, bullish from a medium-term trade signal perspective. Still bearish trend, but I could take a shot at trading that from the long side just to be a little sexy out there, Jonesy, like the CYA position. CYA was up 17% yesterday. Wow, that's not bad. Pretty good. I think that pays a little. That offsets some energy losses. Yeah, that's what it does. That's what we call a portfolio, right? We now have 25 longs instead of 30. There are things that have come out. There are things that have been added in the most recent weeks, which I would say, if you go down the list in terms of what's been added in the most recent weeks that may not be an ETF, bro, United Arab Emirates, Cannabis, MSOS, CYA, BTAL, and CTA. That's what the signal told me to do. That was all right, by the way. I mean, it all worked. So, well, some things that have been in the portfolio for a while here, Japan and Energy, stopped working as well. Other things in the portfolio are working. It's called having asymmetry in your portfolio, which is a principal construction. If you don't have that, you're not drilling, like I've drilled a lot of foundational piles for John McCullough? Like, if you're not providing that foundation in your portfolio, you're not building decks with that guy. Nope. 6 play.
Sorry, I was going through your question. You hit on the ADP number?
No, that's fine.
Okay. Yeah, so that was, to on your point about non-farm payroll over Friday, ADP actually came in at 89,000, which was, down from 180,000.
Oh, so that's why bond yields went down.
Yeah, so I wasn't sure what was happening in the market, but that's why I wanted
That's what I
wanted to
wanted to
interrupt.
do. So this is what's going to happen. I mean, Wall Street is going to be begging for people to lose their job. I mean, it's crazy. It's not crazy. It's consistent, actually. It's sad. It's pathetic. But they don't even know what they're begging for. I mean, they're begging for the recession to start. God, that's when the VIX doesn't go to 20. It goes to 30. When the street realizes that it's a recession, it's VIX at 30, not 20. Okay? Think about it.
Okay, let's hit some questions here. A lot of great questions, so we don't have time to hit on all of them, but I'm going to start with this one from Randall Rossney in Miami. Good morning, gentlemen. I remember this is some history. I remember the 87 crash. Dollar and bond yields had a similar speedy rise. Does your model see any similarities in current build-up?
Yeah, that's why yesterday I instead of seasonality, which is what these monkeys like Detrick have been talking about, I said, well, what was the call on seasonality in 1987? So if you go to that tweet generator, we can dig it out of the back 40, but I used my friends at OpenAI for that. And you can see the similar sets. Those are the two biggest ones. A breakout in both the FX signal and the fixed income, or the fixed signal in the aggregate. I mean, yeah, there's a much higher probability that you have something like that happen than the market trade on a presidential cycle or seasonality. By the way, on the presidential cycles that you cite, did it include like a shit show like we have with even the Irish guys, McCarthy and McHenry, and
Here's the
it's like the conditional factoring. These people don't. Oh, look at that. Go back. There was a nice picture of a dodo version. I know. Look now. Scroll down to the AI. No. AI. You just had it. The 1987. Go up. There.
AI.
You just had it. There it is. AI. October 1987. Type 6 season. Yep.
I was going to say, like, this presidential cycle stuff, like, I obviously follow politics closely, but if you're being quantitative or analytical, it's not enough data points, right? It's like, so you have however many presidential cycles in sort of modern markets.
Yeah.
Okay, so maybe it's performed better, I don't know, but, like, that's not enough data points to conclude anything.
Well, let's just say that
Like,
you're
not even the COVID drug tests would have that few statistics.
right. I mean, so if you're this kind of a person, this is not an investor. This is the type of baby boomer and Gen X person. Not as many millennials, because they weren't there for the first two recessions. Certainly not making market calls or assumptions. Let's really think about it. Why am I so critical of the old wall and these chartists and whatnot? They don't have any other vision because they don't have any other option. They have and many of you had this. Until you had Hedgeye, you didn't have our research team, our models, or any of my signals. I get it. If you don't have any, like watch me go fishing with Luch, my best buddy in Thunder Bay. I'm as clueless as a chart monkey. Now look at his tackle box and all of his weaponry. Like, that guy can fish and hunt. And build.
And arm wrestle.
Now, if you don't have any other choice, you're just mucker with a rod saying, Luch, what should I put on the rod here? Or, by the way, when that bear came over on the right up on the shoal there, Luch takes out his fucking shotgun and fires one to scare the hell out. And I didn't even see or hear the bear coming. Right? You gotta have people with competence. The reason why these chart monkeys exist is because A, there's a chart that gives an illusion of safety or visibility. They have a fishing line. They have a chart, and B, to Jonesy's point, they have one or two talking points. Okay? They just talk. That's called being frequentist theory. Well, this happened this percentage of the time, therefore. Again, just like the rattling off like Stephanie Link garrulously does, a multiple on something that she doesn't have a model on, anybody can do these two things. Provided that they can read, I would say that my kids could achieve the level of analysis, that level of analysis, by the age of 8. Okay? So, yeah, it's a joke. Yes, we're going to be critical of it, and B, we're going to show you a better way. Okay? Next question.
Okay, you've hit on some of this, and an interesting one that was oil today, but I'm going to ask the question. What's a large asset allocation shift you're potentially considering at the moment, aka signal strength breaking down in a bullish trend, or conversely, signal strength picking up in a bearish trend? You mentioned a bunch of ETFs that you've added that are doing that. Thanks. So, large asset allocation shift that you're looking at, or is maybe more in the yellow area?
Well, I mean, the best way to, and this is a Macro Pro subscriber, so the best way to get that answer daily is to watch the positions go up and the positions go down, right? If they're going down, that means that they're losing signal, either losing signal strength or signaling immediate term trade over bot where I'm booking some gains. So if I do that, the second one, that means they come down from the top of the list a little bit and stay in the middle of the list. You know, when you have 25, 30 asset allocations, that's the way it goes. If it stays in that top third of the list, then it's a bullish trade, bullish trend. If it's moving down into the middle to the bottom part of the list, like JPXN, which is right at the bottom, that means that it's lost signal strength. Small cap Japan had been losing signal strength that was in the bottom part of the list, and yesterday I took it up. So that's the functional answer for you, all you Macro Pro subscribers, because you get to see that every day, right? That's like watching Luch. Like, I watch him. When he starts paying attention to his rod and his hand starts moving, I'm like, there's definitely a fish around here. Get my line in the water, right? So we need you to be good observers of the answer, as opposed to the old wall way, which is, Keith, can you give me a couple ideas, a couple picks? What are you going to buy? No. What are you buying is a better answer. What is he doing? That's the answer, actually, right? So something like Turkey's not on our sheet today, but it could go back in there, but may not, you know? So the things that have come in most recently, I already highlighted them today in the top 3 things. There's a lot of stuff in there that I've added recently because they've developed signal strength, or they wouldn't be new positions. So pay attention to them.
Okay.
CYA is probably the most obvious. I mean, that's the one where, that's a direct function of my view that the regime shift has happened in equity vol, or the VIX in particular.
Okay, are we entering a time when a rate steepener like IVOL makes sense?
Yeah, I've been saying that, but I didn't buy that. Because it's not steepening for the reasons that I would buy it, nor is the signal confirming anything other than the it's medium term trade breakup for sure. So when you look at, if I look at, just cancel all of your use of that stuff, and let's start with a better way. So I look at the risk range of YC2C, for example, in my calc, which is the yield curve 10s minus 2s. The risk range on that, I think right now is minus 70 to minus 20 or something like that. The medium term trade breakout line is somewhere in the middle of that. So when it went from minus 70 to minus 55, the yield curve itself went bullish trade, but it's still bearish trend, okay? So that's not going to be a major asset allocation, and you can look at every single time the yield curve on those metrics has busted a move to immediate term trade breakup on my own math. It's been a head fake from a trending perspective. So that's why I'm watching. I literally talk about things that I'm looking at. It's number 5 on I haven't bought it yet, right? But it's there. We're paying attention, always.
All right. This is an oil question. This is a longer term oil question. Keith, in 2008, XLE was trading at 88, similar to today. It was then cut in half as the recession and bear market hit. Are you concerned that we may be seeing something similar later this year as the recession hits hard? Also, as of today, OBX is 33.25 above the 33 threshold we mentioned. I remember 2008 vividly, and my only real mistake was to hold on to energy too long. Wouldn't want to repeat that mistake. I guess, you know, I was thinking about energy too, because I have some energy positions. What really helps all of us is the risk ranges and levels and price picking up.
Yep.
The regime change. But
yeah,
in a recession, yeah.
One, I don't start with the way the question started.
Yeah.
I remember, therefore. Yeah. Who cares what you remember? Just, if you have a chart, you can be 7 years old and remember everything everyone should remember, right? It's called a time series of the day. So I obviously know what happened in 2008. The second part of the question is the answer, right? Which is, what is the signal? That's it. We have a stop loss for that. So, in as much as I'd sell Japan if it breaks trend, I'll sell XLE like my mom if it breaks trend. I won't wear that the whole way down, and I didn't in 08. Okay? So, and my signal's far better today than what it was in 08. But the signal is always the answer to the question. Okay? So when we think about that, keep thinking. I mean, it picks up, there's a lot of reasons why energy stocks break down in a raging bear market, because people, again, there's exit liquidity, you can't own anything, the rate of change of oil peaks and starts to roll over, then breaks down. I mean, that all happened in 08. It could happen now. I don't wake up thinking about that like as a primary thing. I just wake up looking at my signal. Now, what did I do in XLE, XOP, PSCE, yeah, you and me? Did those positions, that's a Macro Pro subscriber, what have I been doing in most recent days and weeks? Have I been taking them up to the top of my list? Or yesterday, what did I do? I sold some of XLE, even though it wasn't up. Okay? So the position is down pretty close to my minimum. I have that position actually, yeah, right at 2%. XLE the day before was 2.5%. I sold 50 basis points. So the signal is already getting me better position for your primary concern without me having to worry about your primary concern, which is 2008. You see the difference? It took me a long time really to stop with the narratives, right? I mean, my own narratives. Hey, Mocker, remember back in 1998 when you had a breakaway against Ohio State and we had to win that game to move on in the tournament? You hit the fucking post. You remember that? Yeah, I remember that. Well, do I start what I'm going to do like as soon as we're done talking here like that? No. No. Play the next play. Play the next signal. Play the next game. And that's really important. You know, and again, it's being constructively critical about the question, because the question should start with the signal, not with a, oh, this could really scare me type thing, because I remember that, right? I remember that game. Yeah. Jeff Hamilton was hurt. It would have been better if he had that breakaway, because it probably would have been in the back of the net.
All right, we're going to wrap it up there. Thanks everybody for tuning in. Back at it tomorrow at 9 a.m. Have a great day out there.
It's everything you wish for. Your site traffic is skyrocketing. Until...
Hey everyone, Peter Zine here, coming to you from Colorado, and the news today is that Gazprom has announced its full year output levels. Gazprom is the Russian natural gas state monopoly, and it is the lowest that it has been since 1978, so well predating the Soviet collapse. And the reason is pretty straightforward. The Europeans have tried to cut their dependence upon Russian natural gas to zero, and at least in terms of the piped natural gas, they've been pretty successful. Now, this is something that is not exactly a shock to people who are familiar with the industry. There are many aspects of the sanctions that are working better than others. This is one of the ones that's definitely working better. And the reason is the nature of natural gas itself. Natural gas is a gas, and it takes a specialized system to produce it, to transport it, and to export it. And if there's a gap anywhere along the system, whether it's in insurance or the pipes or the pumps or the legalities or whatever it happens to be, the whole thing stops, and it can't easily be redirected. And in the case of the Russian stuff that goes to Europe, almost all of it comes from an area called Urengoy, which has been in production now for a half century. Goes down a couple thousand miles of pipes through Ukraine and Belarus into Poland, Germany, Slovakia, Hungary, and the rest. And since this can't be redirected, when the Europeans stopped taking deliveries, the Russians had to bit by bit shut everything down. There are other natural gas options that the Russians have. There's some that comes from eastern Siberia, well east of the Urals, that goes south into China. There are a couple liquefied natural gas facilities, one on Sakhalin Island primarily, which goes to Japan, and one on the Yamal Peninsula, which primarily gets shipped to Europe. And those are still working mostly. But we should expect even those to go offline in the not too distant future. The problem is that those other facilities, the Yamal LNG, Sakhalin LNG, and it's called Kovykta, which is a field in the general vicinity of Irkutsk, out near Lake Baikal, those are all much more technically challenging, and the Russians didn't do any of the work to bring them online. That was almost exclusively done by foreigners, with British major BP being the single largest player, but the Japanese Mitsui and Mitsubishi are involved in Sakhalin, as was ExxonMobil. And most of those companies are now gone. The Japanese are still involved in Sakhalin, but ExxonMobil and BP have just cut their losses and left completely. And the Russians do not have the technical skills necessary to maintain those projects in the long term. As for whether or not the Russians can come back, that's an open question. The Russians used to be the best in the world when it came to ice production and tundra production, but that was in the Soviet period. And the Soviet industrial educational system collapsed around 1985, and the Russian birth rate collapsed in a similar time frame. So not only do they have a significantly fewer people who could theoretically be trained up in engineering, the system that trained them is gone. So the youngest people who have the full suite of, say, petroleum engineering and reservoir management experience are now in their early 60s, and there just aren't that many of them left. And for the last 20 years, most of the meaningful maintenance work that has been done in places like Urengoy, most of the work on improving recovery rates has been done by foreigners, with BP and ExxonMobil, and to a lesser degree the Germans and the Dutch being the major players. That's all gone. So Urengoy, being a mature zone, could probably be brought back as a significant production zone if you applied shale technologies en masse. But as the Americans have shown, shale works in areas that are relatively close to population centers because it requires a significant amount of labor, and it doesn't work very well in places that freeze solid because you need a lot of water. And Urengoy is 1,000 miles from anything that matters. So they will probably never come back online because the Russians can't do it themselves, and the technologies that might allow it to work simply are inappropriate for the geography. In the case of exports to Europe, they are now down by 85% compared to the start of the war. What is left is just a trickle that is going to three countries, Czech Republic, Slovakia, and Hungary, who really don't have any alternatives to taking natural gas supplies from the Russians, which is one of the reasons why Hungary, Slovakia, and to a lesser degree Czech Republic have been the three countries that have been most opposed to the sanctions regimes in general, and most of the exceptions that have been carved out of the sanctions regime involve those three countries. That's not going to change this year. That might start to change next year as the Europeans are building up lots and lots and lots of interconnections so that they can cut their links to Russian natural gas for good. And when that happens, all that will be left of the Russian natural gas industry is what's going to domestic markets and perhaps Sakhalin LNG because the Japanese are involved there, and that's a completely separate political question. But that is crazy because you're talking about the world's largest producer and largest exporter of natural gas vanishing from global markets in less than 4 years. And that is absolutely unprecedented. Honestly, it's more than a mild shock that the price shocks that the Europeans have felt to this point have been so mild. They really have been able to bring in liquefied natural gas from other suppliers, most notably the Persian Gulf and the United States. This has put a lot of price pressure on everyone else who used to get natural gas from those locations. But to this point, I gotta hand it to the Europeans. They have put together a sanctions regime that, at least in part, is doing exactly what they hoped, cutting Russian exports, cutting Russian income without unduly shocking their own system. I honestly did not think they could pull this off, but so far, so good.
Joined by Alfonso Peccatiello of the Macro Compass, filmed in the New York studios of Blockworks. It is, I believe, October 2nd. Alfonso, great to have you back on Forward Guidance. How are you doing?
Very good, Jack. Nice to see you in person. I flew all the way, a bit jet lagged, but happy to do the interview.
And we just had a fantastic lunch, so the macro thoughts are brewing. We are right now in the midst of a huge sell-off in bonds, particularly long-duration bonds. What do you make of it? What are your thoughts?
I think we're watching what the bond market likes to do late cycle. It's not the first time you get this bear steepening, which we're going to talk about late in the cycle. Also, oil prices, I think, are testing the economy and this idea that the economy is resilient. This time is different. That we can handle higher oil prices, that the economy can work and function with 5% interest rates. Well, you get this theory tested, I think, through bond markets and through oil prices. And this is a thing that tends to happen late in the cycle, mechanically, because people who were invested in insurance trades, in recessionary trades, so they were short energy, they were into the long end of the bond markets, they were long bonds, they have to give up at some point their insurance because there is no recession. If for 6 or 9 months you're spending insurance premium in being short risk assets, in being long, the long end part of the bond market, and then this insurance doesn't pay off because there is no recession, you can only keep it for as long on your books until you are forced to give it up. And while you give it up as well, the narrative changes. And that's what we're seeing today. Narrative morphs into, if we didn't get a recession so far, we are never gonna get one. This time is different, the economy can handle 5% interest rates. The Federal Reserve starts to tell you the same, they change their dots. They don't raise the neutral rate, but they basically do that by saying, we'll have to take inflation-adjusted Fed funds to plus 1.5% for 3 years to go. They start going really big in the higher for longer camp, and so the narrative changes and bond markets start to believe that narrative and test it. So they go and they say, why don't we raise long end bond yields? Why don't we make the cost of financing much more expensive throughout the curve? Why don't we normalize term premium? In other words, they tighten the screw really on the economy by raising long-term interest rates, and they, in this way, test whether this hypothesis is really true. If this is true, that this time is different, then nothing bad is going to happen, Jack, because all of a sudden we can handle 5% interest rates for long, the stock market's going to be doing fine, the economy is going to be doing fine. Problem is that every time in the past, late cycle, we tested the hypothesis that this time is different, September 2018, late 2007, late 2000, it ended up that this time wasn't different. Either we had a labor market recession in 2001, we had the great financial crisis in 2008, and we had basically a credit market freeze and an equity market drawdown in 2018, November, December, that led to the power pivot. So often, this time isn't different, but the bond markets likes to test the hypothesis late cycle.
So do you think this time is different? And if it's not different, where are we?
Okay, so big answer is no, this time isn't different. There are many nuances to discuss there. So the thing that has taken me off guard, and with hindsight it's simple now because with hindsight everything is easy, right? Is basically that the macro lags which normally apply between yield curve inversion or the first Federal Reserve hike and the pain being felt in the real economy and in markets as a median time lag. So let's say this macro lag is a median time of about 16 to 18 months. This is the median. The short side of it is about 12. The long side of it is 24 to 27 months. Now, when is the starting date? The starting date is about May, June 2022. This is when the yield curve inverted consistently, so for the first time, and stayed inverted ever since, basically. So if we start counting from, let's say, May 2022, we are now in the month 15, 16. Okay, so we are walking towards the median time when history would say now you should start feeling really the hit from the tightening financial conditions, the yield curve inversion, etc., etc. And we felt the hit so far a bit. One would say the labor market is much slower than it was at the beginning of the year. Core inflation is slowing down. The housing market has decelerated. But is this really pain if measured against how much tightening the Fed has done? Well, the magnitude has been pretty disappointing, right? Has been catching a lot of people by surprise. So why is that? I mean, one should always take new information coming in and assess where do we stand in the macro cycle. And I think it's basically two reasons. One is that the fiscal spending has been outsized by any historical standard for this point in the cycle, especially between October 22 and October 2023. So that's the last fiscal year, which just exhausts as we speak. And the second has been that the length of the macro lags mostly and really depend on when is the effect of higher interest rate going to be felt by the economy. And that is when refinancing comes due, when the refinancing bill comes due. There are two channels really when you feel the hit of higher interest rates as the private sector. The first is if you have floating rate financing, then you're going to feel it pretty much immediately, right? Because your financing is linked to floating rates, and so if the Fed hikes, you're going to feel it straight away. The second is how much refinancing do you actually need to do over, say, the next 12 months? And the US economy was very shielded from both perspectives because the floating rate borrowing, both from households and from corporates, is very limited in the United States. And also the refinancing cliffs were pushed out into the future because corporates borrowed for a very long period fixed. During the pandemic, they took advantage of very low interest rate, and the same did households with mortgages. So that means the refinancing cliffs are pushed down in the future. Floating mortgages and floating corporate borrowing doesn't really exist in the US. It's very small, so you don't feel the hit very.
Hello and welcome to The Fred Meyer Show. At Fred Meyer, everyone wins when it comes to saving big. Because when you order online through the Fred Meyer app, you get the same great prices, deals, and rewards on pickup or delivery that you do in-store, with no hidden...
Very good.
And the pain of higher rates is felt by lenders.
I will get to it, is that House Speaker Kevin McCarthy has been ousted, and that has some potential implications for the economy, for stocks, maybe negative implications, and I'll talk about that in a minute. Today's sell-off, it looked to me, well, there might have been some concerns about McCarthy and his ability to retain the speakership even before that vote came. That may have added some jitters because obviously without a speaker, now the House cannot really advance any new bills or any new business. They need a permanent speaker. I don't know if there's anyone in particular right now who would be considered a front runner. And McCarthy himself might try again to get reelected as speaker, but I don't think he has the votes. Anyway, let's set that aside for a moment. Most of the selling today was once again on interest rate fears. And that is that's been the monetarist reflexive reaction. I mean, we've seen this now for over a year. Last year in October, I gave you almost the exact date when I said that the Fed's rate hikes, we were going to hit an inflection point where the negative impact or the bearish impact from the rate hikes was going to diminish, and the positive impact from increased interest income transfers was going to start to take over. That was in October 2022. I gave you almost the exact date, and that was the bottom. And we've had 7 rate hikes in fiscal year 2023, which just ended on Friday, by the way. Yeah, we also got the first data for fiscal year 2024. I'll talk about that in a second. But we've had these reflexive headline selling, and what amuses me is that I literally saw headlines today saying the market is plunging or has plunged. Folks, we're down 1.3% today. I was a trader in 1987. And I lived through the crash of 87 when the market went down 22% in a single day. Okay, so you're not going to get me all, running for the hills because it's down 1.3%. And I get a kick out of the headlines when they say the market is plunging on a 1.3% down day. I literally personally experienced a 22%. That would be almost like 7,000 Dow points. It would be like 900 S&P points. So you could see the hysteria. You could see that, this generation of investors, people now, they just, no perspective. But it's also a function of the fact that the media always has to, they got to get eyeballs. They got to get people reading their articles or watching their shows, and fear is a big motivator, so it's always kind of framed in that perspective. Now, some of you here, you say, well, Mike, you said this was going to happen last Tuesday, and Wednesday it didn't happen. Like, if you're here for that, I think you're in the wrong place. As much as I try to give guidance on short-term moves based on the flows, I really always reinforce the idea that you have to have the macro picture in your head, and it's really about that macro picture in the long term. I try to offer guidance on, shorter term stuff, and most of the time it works out, but there are going to be times like today where, a headline pops up or something happens, like the 10-year went to 4.8%, and we know that, with the exception of the stuff I talk about and people here on this channel, myself, they're my friends again, those yappy dogs. Maybe it's my voice, I don't know. We know that, it's 100% the monetarist view. And we know what triggers their behavior. And we know that their behavior is wrong. Because, for a bunch of reasons. Number one, it's emotional. Number two, most important, I think, is that they really don't even understand monetary policy. Like I always say, they see it as a single variable reality, when in fact it's not a single variable. When rates go up, there are winners and there are losers. When rates go down, there are winners and there are losers. Same thing with inflation, same thing with taxation, all this kind of stuff. So they're living in a world which is not the correct understanding of reality, basically. But their behavior is driven by their understanding, and also they are, like I said, that's the 100% of people. Really, what I do, I wouldn't even call it the 1%. It's fractional. You might as well just say, it's a very, very tiny group. what's out there in the financial media, in the mainstream economics world, on Wall Street, it's 100% monetarism. And again, they really don't even have a grasp of monetarism in the sense of how it impacts the economy or sectors of the economy. Anyway, so I mean, if you're coming here and you're saying, Mike, you said that was going to happen on Tuesday, and the other thing happened on, I mean, that's just, you're in the wrong place. I mean, I'm trying to keep you guys focused on the macro picture. It's kind of like saying, let's say I was a time traveler and I went back and to before the Grand Canyon was even formed. I don't know, how old is the Grand Canyon? I think like 18, 20 million years old or something like that. And you're standing in that region where the Colorado River was flowing, and you're telling somebody, 18 million years from now, there's going to be this gigantic canyon carved through this landscape, and the other person's saying like, are you kidding me? It's just a river flowing. In fact, sometimes I even see the dirt filling back up into the river. Then you go away and you come back. I'm a time traveler, and now you come to today. It's one of the great geological wonders of the world, how this river over time, same thing with macro and all this stuff that I talk about. That's why I was able to say last year, there's not going to be a recession in 2023. Stocks were going to go up, which they did. Day to day, anything can happen. You can have an event pop up. And I guess that's a good segue. I ought to talk about McCarthy. I had no particular love for McCarthy. The thing that gets me is that the group that ousted him, the group of Republicans, and by the way, all Democrats voted against him as well, but the group was led by Matt Gaetz from Florida and his compatriots. What bothers me about this whole thing is not necessarily that McCarthy lost his job, but Gaetz is a big time, and all the people who follow him, he's a big time deficit and fiscal hawk, okay? Constantly talking about, government is spending too much and how we're gonna pay this back, and just this, his whole understanding is mired in this misinformation and lack of understanding and just sheer ignorance about how the monetary system functions and how sovereign money, and absolutely no clue about MMT and stuff like that. I mean, to him, we've got this massive debt, it has to be paid off, all this bullshit that we hear all the time. Now this is potentially bad news. I mean, right now it's not, because we don't have a speaker, and no new spending bills are going to happen because we got this continuing resolution which will take us into November. But after that, there could be a problem. I mean, we're looking at possibly a significant swing to a much more, or I should say, a hawkish fiscal environment. And if that comes to pass, that's not just a short-term top. That's like a serious top, and well, let me just put it this way, a serious contraction in the U.S. economy. I mean, these people are talking about cutting entitlements, they're talking about cutting, basically cutting everything. Maybe not defense, but so that's out there as a potentiality. That is out there, and it's something that, the politics now are going to become very important to watch. I mean, again, not in the next 45 days necessarily, because nothing's going to change, but you got to watch it now to see who's going to go in there as speaker, what the rhetoric is in terms of what their fiscal outlook is going to be. And right now, I don't like what I'm hearing. So that's something really we got to pay attention to. Now, the first numbers of the fiscal year came out, the daily treasury statement. There was a Yesterday, there was a 14.7, I think, billion drain. That could explain some of today's down move. However, there was also a Social Security payment today, so we could say that maybe the down move would have been worse if it were not for that Social Security payment. And I also think, just to repeat myself, that I think this anxiety over what's going on in Congress with the House of Representatives and McCarthy, I think that was hanging over the market as well. 1.3% down is not a plunge. Okay, that was a headline on Drudge. That is not a plunge, folks. Again, I lived through a 22% in one day. For those of you, too young to remember that or whatever, do the math. 22% of where's the Dow now? 33,000 or something. Where's the S&P? 4,300. You're talking about 900 points down in one day on the S&P. That's the equivalent of what that would be if that happened today. So it doesn't, something like this, it just, I don't even really pay attention to it. I didn't expect it, but I don't really pay it. It doesn't shake me up whatsoever. Now, what I will be following, aside from the politics, which I just mentioned, and is something that I talked about yesterday. I want to see these daily flows now, in particular, because, we're right back into this situation of student loan payments having to be made after a moratorium of the last, 3 years. And I want to see how that's going to affect mainly, the deficit. In other words, the deficit of the government equates to the net addition to the financial balances of the non-government, of us, right? If the government runs a deficit of 1.7 trillion, by definition, that means 1.7 trillion was added to the financial balances of the non-government globally, in dollars. So I said yesterday, and I've been saying in my videos, if we start to see that shrink materially, not just a little bit, but if we really start to see that shrink, that is an indication that these student loan payments are having a negative effect. But one day is not enough data. Okay, we need to see more data. And by the way, yesterday's flows were about 7 billion below the flows of the first day of fiscal year 2023. All right, so we compare first day fiscal year 2024 to first day fiscal year 2023. It was down 6.8 billion. But again, you can't go by one day of data. You have to see how this plays out. You have to see what kind of a trend develops from this, whether it's positive in terms of increasing flows or negative in terms of contracting flows. So not a whole lot to do right now. We got to keep our eyes open, watch what's going on the political front. We know, or I told you guys months ago, that coming into September, October, we're going to have a down period because we have two tax strains. We had the tax strain on September 15th, which we recovered all that. Now we got the tax strain coming up on October 15th. Okay, I said this all in advance. But I said that the overarching picture was bullish. But now with this development in the House, I'm not so sure. We have to see. But it's not a good sign that Matt Gaetz's group in the House, who are all die-hard fiscal conservatives, who don't understand how the monetary system functions and things like, we have this massive debt and we got to cut spending. That's just a bad political, or potentially very bad political environment right now. Nothing has happened yet. There hasn't been no new, spending authorizations or budgets, but it's something we have to be aware of. Okay? Anyway, that's it for today, folks. Don't forget, go to my website, pitbulleconomics.com, if you want to follow along with the how these flows are developing. I think you should get my course on understanding the daily treasury statement. It's $99. You'll be able to work through these numbers. The daily treasury statement is a free resource put out every day at 4 p.m. Eastern time by the Treasury Department. It's literally like looking at the checkbook of the United States government, and it's the most leading indicator, the most leading resource. You know, all these economists on Wall Street, they're looking at government numbers that are put out every 30 days, every quarter, every year. They're so behind. You know, they're trying to they're trying to extrapolate out from these things, and basically they're just looking in their rearview mirror. As I've said so many times, these flows, that's the first derivative. That's the core of the analysis. You have to understand that. And it's not hard. I mean, you basically, if you look at these numbers and you know what to look at and how to, record the data, it's very simple. Go to my website, pitbulleconomics.com, and get your video. See you tomorrow. Bye.
Don't miss the fall tire sale at Fuentes Tire and Auto. Now through October 14th, save up to $150 on a set of Toyo tires. That's up to $150.
This is China's last decade as a coherent nation state, so we're going to be very soon talking about Chinese weakness and the effect of Chinese disintegration. There's nothing that is made in China that can't be made anywhere else. Because the demographics have been aging so aggressively for so long, their labor costs are now about 3 times what the labor costs of Mexico are. And Chinese labor is not as highly skilled as Mexican labor. So we've already seen the hemorrhaging out of the industrial space, most notably to Mexico and Vietnam and some of the United States as well. In fact, the United States is competing on some of these sectors that we honestly have given up on, because now with the shale revolution, our energy prices are the lowest in the world, our electricity prices are the lowest in the world. So we're in this weird world where the United States excels at the high end and the low end at the same time, while the Mexicans take care of everything in the middle. It's a very successful system, and it's outcompeting the Chinese on those metrics. Second, the Chinese do not have the naval capacity to push out from Europe. Yes, they've got a lot of vessels, but only about 10% of them can sail more than 1,000 miles from the coast. And that assumes no one's shooting at them and they're going slow to save fuel. Really, the operational range for the Chinese Navy is only about 300 miles. So they can't get past Vietnam, much less to the Persian Gulf if there's an energy crisis. And then third, back to those demographics. Since the book came out, the Chinese have been updating bit by bit their census data, and they've now come to the public conclusion that they overcounted their population by in excess of 100 million people, with all of those missing millions aged 40 and under. If that is true, and I can't imagine that they'd be bad-mouthing themselves to make themselves look good. I mean, the logic of that's weird. If that's true, we are talking about the fastest workforce and population decline ever in human history. And we don't even have an economic model as a species for what will work with the Chinese system just 5-10 years from now, because they won't have enough people to do the work, and they certainly won't have enough people to consume. And that leaves them completely dependent upon whether the United States wants to import stuff from them. It's become very clear in our politics under both Trump and Biden, and the answer to that is no. What Dalio got wrong is the reason that these countries did well in the time frames that they did is that their geography matched up to the premier technologies of the day. Before deepwater navigation, the most powerful country was the country with the best maritime internal transport system, that was Ottoman Turkey. But then deepwater navigation kicked in, and so the center of power shifted over to Iberia because they were on the end of a peninsula, and it was easier for the Portuguese and the Spanish to push out through the water and conquer the world than to go through Europe. Eventually that technology migrated to places that could use it better, like the Brits. And then the Brits developed industrialization. And industrialization allowed them to bring a gun to a knife fight for a century, but then that technology moved to an area with better capital density that could use use it better. That was Germany and the United States. So it's not that he's wrong about those arcs, but it's not like they have a use-by date. It's a question of what the technologies of the day tend to be and which geography can use those best. I am, at the moment, not convinced that the digital age is a fundamentally sufficient break from the industrial age to trigger something new. But even if it is, something to consider that 90% of all the silicon that goes into all of the world's microchips comes from North Carolina. I'm bummed that globalization is ending. It's created the best period in human history. But I'm really excited to see what's next. Because if you've got North America really fundamentally remaking itself in less than a decade, that is going to change the American story, the Mexican story, the Canadian story. And that's going to take us some unpredictable ways. Hopefully most of them are going to be good. And on the back side of this, after everything cracks apart, fast forward 10, 15, probably closer to 30, 35 years, and we'll probably have a better battery system, and we'll have a better transmission system, and then we can go back out in the world and basically remake it from the ground up. It's a great time to be alive, if you're in the right spot. I am concerned about a series of brush fire wars as countries try to take matters into their own hands. But a lot of the countries that we've been convinced of that are significant long-term threats, most notably China and Iran, really are the countries that are going to suffer the most from globalization's fall. They really do need American overwatch in order to make sure that they can import and export. And without that, they are utterly incapable of managing that themselves. In the pre-globalized world, unless you had iron ore and steel and food and oil, you never industrialized. With globalization, now you only needed one or just a bunch of labor that you could use to buy all of it. Globalization made the world safe for civilian corporate traffic the world over. You take that away, and you're now traded on your own internal market, your own security environment, your own economic geography, and the world we're going to go to is going to have a lot more in common with the 1840s than the 1940s, because everyone is industrialized and modernized, but they're dependent on products coming from half a world away that just aren't going to be there. Now, if that's a car, that's bad. If that's wheat, that's worse. Globalization allowed us to farm things out. Everyone focused on what they did best and most efficiently, even if they were tilting the balance like the Chinese did with subsidies in order to make it happen. That meant we've got sprawling supply chains that around the world. Most manufacturing processes, especially in electronics, touch at least a dozen different countries. We now have to unwind all that. And we have to put it on a more stable system with shorter supply chains that are closer to home. And NAFTA is well set up to do this. But this transition period means we have to double the size of our industrial plant in just 5 years if the goal is to still have the products that we're used to today. That's hugely inflationary. But think about what it means. Doubling the size of an industrial plant. Having locals produce products for locals. Partnering with the Mexicans and the Canadians to make it happen at scale. This is going to be the greatest economic growth in the history of all 3 of the NAFTA countries. And when it's done, we will largely be immune to international shocks because all the work will be done here. This is a good story, but it's not a straight road from here to there. I have always been a maps guy. It's been my job to communicate to clients my entire professional year about how the world fits together, why it fits together the way it does. And once you understand the tools of geography and demography, you can then have a much better idea of what is going to evolve or devolve in weeks, years, months to come. And we are now standing at the precipice. Well, actually, no, that's not quite right. We just kind of took a big step off the ledge in the last couple of years. The globalized system, as we understand it, is breaking down, and it's my job to help figure out what that means for different companies in different parts of the world and different economic sectors. Well, the biggest change happened within a week of me turning in the final draft at the start of the Ukraine war. Luckily, the publisher allowed me to go in and change a few verb tenses, so it was instead, Russia will do this inevitably and almost imminently into, Russia started this last February, and here's where we are. The key thing to remember, though, is that the prediction of the Ukraine war wasn't just from this book, it was from previous books as well. And when you have deglobalization really kick in, it's only one of 3 conflicts. So we do have 2 others that are just around the corner that are going to be just as disruptive. Now that the United States is no longer in the Persian Gulf in any meaningful way, the Saudis and the Iranians Americans are edging ever closer to a direct fight, and that's going to catch half of the world's globally traded oil in the crossfire. And then whether it's because the Chinese lash out or implode, we're going to have another conflict in the East Asian rim with the Chinese and the Japanese being the primary belligerents. And then that's the end of global manufacturing as we understand it.
Hey everybody, Peter Zion here. This one is on California. Now, California has been one of the most successful economic cases in the United States for the last 4 decades for a mix of reasons that are largely beyond the control of California. The first one is immigration. Natural population growth, even among migrants in California, has been negative for some time. And it has only been with large-scale inward international migration that California has continued to grow in terms of population. 1. 2, the millennials. One of the things that we saw when the millennials came of age in the 2000s and the 2010s is they wanted an urban coastal experience. And California, LA, San Francisco were some of the big beneficiaries of that. So you've got millennials going from the middle of the country to the coast. And LA thrived in that sort of environment. It was still not enough to overcome internal population decline, but having this constant influx of people in their 20s and then later in their 30s really helped with tax rates, really helped with the labor force. You put these two things together and then you apply the third factor, which is capital availability, you get a very different economic model. One of the things to remember about capital availability is it's determined by the number of mature workers you have vis-a-vis the rest of the population. Basically, when you're in your 20s and your 30s, you're borrowing a lot to fund consumption for college, for raising kids, for buying homes and whatnot. That capital comes from people who are in their late 40s to early 60s, where the kids have gone away and they're at the height of their earning experience, but their expenses have gone down. So that has been the baby boomers since roughly 1990, and it's generated a capital environment that's been wonderful. This has been great for economic development for a lot of regions, a lot of states, a lot of countries. But in California, when it came together with those millennials that were influenced